So good afternoon, everybody. It's a pleasure and a true honor to be here. As mentioned, my name is Michael Beal, and I'm one of the co-founders and the CEO of Data Capital Management. We are an artificial intelligence hedge fund based out of New York, and as he mentioned, prior to that, I was the co-founder of the Big Data and Machine Learning Group for JP Morgan, where we sat up in corporate, had access to data across all the different lines of businesses, and our objective was to create a new data-based stream of revenue for the firm. And so as we speak here, I think one of the key things to take away is that I'm not exactly sure as to what's the context of the audience. So I'm going to try to hit on a couple of points and to really highlight that the issues that we're facing at Data Capital Management are really the same issues that we faced at JP Morgan. One big difference is that it would take me about 30 years at Data Capital Management to spend the budget that I had on an annual basis at JP Morgan. However, we've really been enabled to focus in on productivity, on innovation, and the key of the message here is that Mr. and Mrs. Market are one of the most demanding customers anybody could have. They tell you on a day in and day out basis whether you're correct, whether all the investments in your system and algorithms were even worth anything. But that also leads to a tremendously fertile ground for machine learning. And so we're going to spend a little bit of time here talking about kind of why is artificial intelligence now permeating and infiltrating capital markets, what's the benefit there. And then I'm going to skip over trying to prove to you that artificial intelligence adds value as a standalone, but I'll speak to it about some of the use cases that we discuss. And really what I always try to use these presentations to do, both to kind of share externally, but then also to get my mindset around internal questions, is really what are the things that investors and third parties are asking me on a consistent basis, and how can we try to spend some time answering those. And so one of the things that continues to come up is this idea that if and when artificial intelligence really does permeate itself into the investment decision process, won't all returns be commoditized to zero? And the answer there is no, because there are too many degrees of freedom associated with actually coming up with a strategy. And so what I hope you'll find interesting, helpful, thought-provoking, and give you some action items as to where you should spend your time is walking through some of those challenges in the example of a case study. And from there, we'll talk a little bit about what are the next opportunities for research and where would be some places that we'd really love to know if you're investing time, resources, and energy. As what we've done on the data side is that we've come together with CTOs from various quantitative institutions as well as fundamental investing firms to really kind of share our thoughts as to this challenge of dealing with big data. That's no longer our issue. Our real focus is around artificial intelligence. And so we've actually created a similar group which is focused around that. And to the extent any of you are actually diving into this in a deep level and you find these things interesting and believe that it's something that you really want to focus in on, please find me afterwards for drinks. I don't think I'll have time for questions, but we'll go from there. So this is the DCM system. As you can see, it approximates a neural network. And the way that we were really thinking about building out the entire system, and one of the core components associated with our approach versus others, is that once we've approved an investment strategy, there is no longer any room for human intervention. And so from the strategy development to the execution to the data onboarding, everything is fully modular and it speaks together in a very interconnected graph. And then the other core component that you should take away from this is that most of the innovations around artificial intelligence have actually been developed over in California for the West Coast technology problem to be solved. The corporate graph here is based off of Facebook's NeuroGraph, which ties together all the people in this room and everywhere else, and we use it for some of our strategy decision making. But we really have spent a lot of time focused in on this, and actually we started this in 2014, and it's been a long road since then. Why is it that we actually spent all this time? As I'm sure you've been hearing about big data, it's a buzzword now. But what it really meant to me, and this was sitting back in 2009 when I was at TPG Capital, I spent a lot of time in the Berkeley Amp Lab and with the Google guys. And what I realized is what they were actually working on was a way for information that previously we had to get via conversations or experts to actually come available in a machine-readable format and more importantly, not to have to wait for a batch-based kind of protocols for that information to be delivered to you, but rather you could catch it in real time and do the aggregations of the insights yourself. And more importantly, what we found ourselves in and what we continue to find ourselves in is a world where on the left here, you see that this information is coming in smaller and smaller increments, and the value of it is diminishing by the moment. Rather than actually paying attention to quarterly earnings or the forecasts of an investor or a bank, which will be released on a kind of monthly or quarterly basis, now you can do the bottoms-up information of tracking kind of how many users does Netflix have, how many purchases and clicks are there on Amazon's website, and do all of that work yourself. And because of that, that actually enables a tremendously fertile ground, again, for machine learning, but just general insights, whereby now you have all of these new information sources, which are essentially giving you a contextual understanding as to how and why prices are moving. But the problem that we faced, and actually here, I'm very fortunate to have truly the smartest people that I've ever met as my co-founders for Data Capital Management. I see a few of them sitting in the back here. But every year we come to this conference, and in 2015, I posted on my Instagram, I had a lot fewer followers back then, that this is our team trip at the annual NYC Big Data Week conference. Big data is becoming mainstream. It's time to dive deeper into unsupervised machine learning on big data. Hashtag catch us if you can. The purpose there was that if you look back at this, what I realized was that we spent a lot of time, the first 2 years of our existence were really on how do we take all these data sources, how do we integrate them, how do we make them accessible, how can we do the analysis. But then once we found that once we had all this information, there was a bottleneck associated with creating strategies, right? Being able to go through all this information, test out your thesis. What we ended up finding was that while we were a new fund, we were actually doing it in a fairly discretionary and quantitative investment approach, right? When you look at a discretionary approach, the goal there is to really take the intuition of the most senior investor who has been able to develop this intuition over a course, a very successful career, and to then apply that to whatever problem that you're seeking to solve. And so we did a lot of that, but we were able to actually look at new data sources to take it from this, what I felt has a problem around confirmation bias of the successful intuition of the senior investor, and give it some actual factual grounding. And then as we progressed, we started thinking more, and most of the team, my co-founders come from the quant research team of JP Morgan. We started applying more of our traditional quantitative investment approaches where we were fitting kind of parametric models to this type of data. And again, it was valuable, however, it was just too slow. All right, so going back to 2015, that's when we had the realization that if you want to be in machine learning, or if you want to be in big data, you actually have to, by definition, really start to apply machine learning to be able to find the various connections, as we mentioned here, as to all of the different data that we have in our system or have access to, and its impact on a given price movement. And so that's really where we've switched the investment process approach on its head. No longer are we kind of just testing, well, we still do some of this, but we have two approaches. It's no longer solely constrained to either testing a fundamental investment process or idea or a quantitative investment thesis on the data and doing a traditional dev, test, prod, and deployment approach. Now what we do is we're asking questions of the data. We're specifically asking, what's a good strategy? I'm looking for good longs. I'm looking for good shorts. Here's a bunch of data. Can you come up with the answer towards that? And so again, I'm going to skip over why that's actually valuable, and happy to talk about that at a later point if anybody are still doubters. However, when you see artificial intelligence proliferation in every single aspect of our lives, you have to be the turtle with their head in the sand in order to believe that it's not really going to apply value in this context. And instead, I'm going to focus in on this question, as I mentioned, as to, well, why should we invest all this time in it? If we invest all this time and energy, and other people invest all this time and energy, won't I just end up with commoditized returns? And it seems like that would be a logical answer, because when you look at it, investing is perfectly suited for machine learning, right? While there's lots of permutations to the problem to solve, you're actually just asking a simple problem every single time, but the answer varies because of fluctuations in the independent variable and its impact on your target variable. But at its core, all you're seeking to do is to buy low, sell high, be able to identify when you're in negative momentum trends and to be able to ride that, and to be able to identify when you're moving back into a positive trend. This happens on every single stock at every single duration. This could be an intraday chart, this could be a daily chart, it could be a monthly chart. At the end of the day, regardless of the way that you invest, the questions are always the same, and it's really just how willing are you to deal with the volatility if you were to have started at point A and held it over to the last point on the right. And in particular, because the investment process is fairly repeatable, regardless of whether you're a fundamental investor or you're a quantitative investor, your process is fairly the same. You have to figure out how to acquire the data such that you can address and research the project. After that, you have to figure out what types of analysis you want to do, and that may be artificial intelligence on our side, but that may be a traditional DCF if you're a fundamental investor, and it may be a simple correlation metrics if you're a quantitative investor. And at the end of that, now that you have your insight, you actually have to figure out how to make the decision. And there's lots of permutations with that as well. For us, we're fully systematic. However, there's nothing that says that you can't actually hand this off to a human and have that human make the decision with the benefit of the machine learning analysis. And what's most important to me, and the reason that I'm here, is because of this idea of tragedy of the anti-commons versus tragedy of the commons. We have a reputation for speaking in depth about some of the things that we do, which is a no-no for our industry. However, the reason that we do that is because, as you'll see here, there are so many permutations along the decision tree that it's very hard to believe that we're all going to come to the same answer. And therefore, rather than worrying about this tragedy of the commons, which is the overuse of any given idea, what I'm more concerned about is this tragedy of the anti-commons, whereby we all believe that just because we spent some time working on something, that it's therefore not only proprietary, but proprietarily valuable, and therefore we have to hold it to our chest. If that's the way that the industry continues to play out, then what you're going to have is actually no benefits in recycling of the R&D and the external properties that come from that. So with that context, let's actually dive into it. One of the things that we've actually done over the course actually of the last year is that we've started a small consulting business. My colleague Jasa here represents that and leads that for us. The purpose of that is that we kept getting people asking us questions associated with, we can't build out a data science team, can you help us answer some of those questions? And so we do that on a case-by-case basis. When people are asking us interesting questions, we kind of like working with the team. And so the examples that I'm going to use here are one of those case studies. And as you see, we'll walk through it in fairly detail, but what you'll see is that it's impossible to expect that manager DCM will come to the same answer as manager X. So in this context, the client was pretty interested in understanding what is the impact of private equity ownership on stock returns. And furthermore, they wanted us to be able to determine the key factors for a strategy around PE ownership and to devise a strategy that enters and exits based upon PE ownership as being the core criteria. And that this strategy, there are only a few limitations. The strategy should have hold periods between 5 days and a month. Strategy should be market neutral by design, and the strategy should deliver 15% annualized with a 2.0 Sharpe. This is no different than what Ali, our Chief Investment Officer, will say to us in terms of portfolio construction and the requirements as to new strategies that we're seeking to give out, but I'd prefer not to expose that. I hope my battery doesn't die during this. Excuse me. Perfect. Okay, so the first question here is around data acquisition. And what we're going to do for this discussion is just assume that you've been told, or we've been told, exactly what type of data that we can use. One of the key issues is that if you don't have the same data loaded, even a few factors off, your machine learning algorithms are going to come to different answers. But in this context, let's pretend that what the focus was around, first, can you identify the universe is all US exchange traded stocks. We go back to 2000. We're trying to identify the difference between PE ownership, VC ownership, and hedge fund ownership. To do that, we're allowed to use price and volume data, economic data, and derived data. We're allowed to use traditional fundamental data in the form of 10Ks and Qs, as well as figure out fund holdings based upon the K1. In addition, we're able to use news data, and that's particularly important because the K1 comes out at the end of the quarter. It's better to be able to understand what's happening at the exact time that they came in, and you actually need the news announcement to be able to tie it back to the date that the fund actually was owned. We're using, for a different part of this analysis, flight records data, as there were some questions around there, and then general Internet of Things. And our target variable is average daily return, return by the windows. In this context, I think they were looking at 3-month holds, and then the daily win-loss ratio. That's what we're seeking to optimize. So I'm going to ask this question, but I don't want the answer. Given a set of defined data and objective variables, how many of you would think that Manager A, DCM, and Manager B would all come to the same answer? Well, in order to believe that, you have to deal with all of these challenges that one has. All right? Even if you know what type of data that you actually want to deal with, it's a big challenge, and we spent 2 years just building our system to be able to deal with this, as to how are you actually going to pull all of this data into your system. All right? Are you going to do ETLs, which is extract, transform, load, in which case you're actually cutting off a lot of the data before it actually comes into your raw system? Or are you going to do more ELTs, where you pull everything in and then you transform it upon analysis? The latter is going to have a lot of implications towards your processing power and the way that you think about that. For us, we have a hybrid, and it depends on the different types of states that we're looking at. And then finally, I'll skip down to the bottom here. How are you going to think about your data models? Is it going to be a upfront SQL query where you've really spent a lot of time defining not only your data objects, but the relationships of your data objects? Or are you going to have it be more application task specific, where you have more of a flat data farm, and then it's again on the upstream analysis to figure out how to tie that together? Quick hint, if you decide to go with upfront relational data models, a lot of the things that we do in artificial intelligence are going to be very, very challenging. It'll be very difficult to tie the information together. The next point that I'd highlight here is that how are you going to deal with actually integrating it? So now assume that you have all the data pulled together. You figured out how to leverage a machine learning algorithm to backfill some of the information that didn't exist. You figured out how to take news and turn it into natural language processing to turn that into structured data that can be leveraged. Now the problem is, how are you going to tie all this stuff together? And in particular, I'd like to highlight this component of data by temporality. And when we get to the end, what you'll notice is that this is something that is a big challenge towards using traditional out-of-the-box artificial intelligence programs. West Coast does not care about bitemporality. You kind of act the same over, once you hit 20, you're basically the same person. However, the way that a stock decides to react in 2008 is completely different from the way it'll react in 2009, even if, by chance, all of the other factors happen to be the same. So that actually is a very challenging component of here. And then the last component here is about, assume that you have all this data here, how are you actually going to do the analysis and structure it to be there? And one of the problems that I learned from JP Morgan was that because we had to deal with a physical infrastructure, we actually had to buy huge server racks in order to be able to support what were kind of peak capacities around 6 p.m. when all the data scientists were doing their analytics. However, during the rest of the time, you had these big boxes that were costing a lot and taking up a lot of rack space, but were not necessarily fully filled. And so that creates a big problem because machine learning does require a lot of computational power. However, it's going to be difficult, and particularly if you're in the early stages, if you have to build for all of the power that you're going to need, eventually you're going to have some smart CFO in your organization come through and say that your utilization metrics are off, and you end up going to lose some boxes off of that. So those would be the core components that I'd say that are big challenges around that, as well as kind of how you think about microservices. One component about there is as you're doing machine learning, lots of small components will fail. And if you have to rerun the entire process, you'll end up running these algorithms forever. If you have the ability to break them down into subcomponents, then even if there are failures, then you have the ability to recover from that fairly quickly. But let's assume that you've done as we have, and you figured out a way to take all of this data, economic, fundamental, price, news, and novel data, tie it together with your kind of understanding and cybersecurity, and figure out how to get that into a cloud environment that is enabling massive progress and processing in a parallel and distributed manner. Well, you've got one part of it done, right? You've got data acquisition done. However, as you can imagine, there are so many degrees of freedom associated with what we just spoke about that while I know that I really like our approach, I can't say that it's the best approach for every person here. Actually, I can probably tell you that it's not. And therefore, you're likely to take similar concepts but do them in a different manner. And those ways that you deal with, whether you want to deal with intraday tick data, whether you want to deal with aggregated bar level data, whether you minutes, et cetera, will lead to totally different answers associated with your artificial intelligence analysis. So in any case, let's move on to the next. So now, assume that you have your data all set up, and you say, well, now I want to throw machine learning. Shouldn't that all come to the same place? Well, the problem here is that there is no such thing as machine learning. There are hundreds and thousands of different subcomponents, ranging from supervised to unsupervised, shallow to deep. And more importantly, each one of these subcomponents has very low correlations to the other types. And this comes from a JP Morgan report, and if you haven't read it, I suggest that you do. It's a pretty good report. But what I'd highlight here is that when you look at this Atari game example, we all know that DeepMind has been able to win at Google, chess, and all these Atari games. However, it is not the same machine learning algorithm that is playing in each one of these different games. They are different algorithms which are trained to different games. And if you tried to take one of these algorithms that was trained on Pong and try to apply it to Tetris, it would fail dramatically. These things are very specific to what they do. Oh, that's great. So, in any case, as I look here and see if this will turn back on in some moments. So when you look at this thing from a components perspective of, is that good? All right, so then the next stage, forgetting this component here. So now let's say that your next component is that you want to be able to figure out what is the impact of all of this machine learning. And so now you take all of your different factors and you want to apply it, and you've been actually told that rather than being able to use all of these different machine learning approaches, you are constrained to only using 3. You're allowed to use natural language processing, you're allowed to use Bayesian analysis, and you're allowed to use decision nets. Well, the core component here is that even when you try to apply a Bayesian analysis, what's going to end up coming is that in this context, what the slide would say is that if you use an unsupervised machine learning approach, you're going to end up coming out to a different answer as to what types of factors matter the most to any given problem than you would if you use the exact same machine learning algorithm, in this case a Bayesian network, but you decide to use a supervised learning approach. They're going to come out with very different answers. That's even more important than if you move from having an unsupervised approach to now you're leveraging a supervised learning approach. And in this context, with the supervised learning approach, you're going to continue to have different answers. But let's imagine that, okay, great, we're back. I reserve my right to reclaim my time, as they say. Okay, so I'm going to skip through this. In this context, you had one which was applying an unsupervised learning approach, in which case it tells us that what really matters to the decision is average trading volume, total assets, total debt, and total liabilities. Now you've decided to actually set a target, which is moving from an unsupervised to a supervised approach, and you get a very different set of answers. So even within one set of machine learning, you have degrees of freedom as to how you deal with that. And even within supervised machine learning, if you choose a different subcomponent of the Bayesian approaches, again, you're going to come up with a different answer. And in this context, what we focused in on was, given the answer as to what defines private equity ownership, how can you distinguish good longs versus shorts? But let's imagine that you get through this and you determine what are the factors that really matter, and somehow you've come to the same factors that the rest of the industry has come to. Well, in this problem now, you take all of these different factors to be informative to the problem to be solved, and it should be easy. You just throw it into a decision tree. And now you've got your decision tree, and it's given you your various layers. In this context, it's a 1, 2, 3, 4-layer graph, or 3-layer graph with a bunch of nodes at the end and leaves at the end. So great, you have your answer. Oh, this doesn't show up very well. But here's the problem. You're never just running one. You're running hundreds and thousands of these. And a given set of those, call it 100 or so, are all going to have very successful answers. These all range from 58 to 56% hit ratios, which are a little low for us, but they seem to all look nice. But again, that requires another machine learning algorithm to figure out how do you optimize from all of the answers that could satisfy down to the set of features that you really like. But again, let's imagine somehow that we all came to the same data, the same set of factors, as well as the same one of these decision trees leveraging those factors, same depth that we want to go with. So now you have, under this assumption, same data and the exact same analysis. The last component is about actually making a decision. And imagine that because of the way that you stored your data, you had to do your analysis on end-of-day bars instead of intraday bars. So now your question is, you have your rules as to what day should I enter, but you have to try to figure out how should I enter, what time. My goal is to buy as low during that day as possible. So maybe you use a support vector machine learning algorithm leveraging just two simple factors, RSI and simple moving average, and you've trained it based upon what is the daily minimum for that day. What this does is it creates the clusters and the regions associated with good times versus bad times, and then you can turn it from a clustering algorithm into more of a prediction algorithm, and you can see here that the answer was on just a given day for here, that it tried to buy at 9:31, 9:43, 10:07, but interesting, over time it realized, no, actually it doesn't make sense for me to buy at spot times. I should be providing windows, and so towards the later half of the day, it started to provide 3 windows, and it didn't capture the end of the day because it had already run across its limit as to how many times it can enter. And then finally, so now you figured out how to enter, now your problem is, how do I get out, right? And so in this context, you have a market-neutral portfolio. Some are going up, some are coming down, and your goal is, okay, should I exit at A, should I enter at B, exit at B, C, or D? So you decide, hey, fine, I'm going to throw a hidden Markov machine learning algorithm at this. And what this has enabled us to do is to, rather than have static configuration files associated with the exit, it's adapting to the rest of the information that's around there. And in this context, it ended up extending the duration of the hold by, I think, 3 days, and then it pulled it back. And it went from what we had programmed as a 10% gain to actually learning that it was a 76% gain over that time frame. So the key takeaway is that in order for everything to come to the same answer across various managers, you would have to have the exact same process around data acquisition, exact same process around analysis, as well as the exact same criteria and process around your decision making of enter, exit, which is a function of your various degrees of risk tolerance. So I hope that this short talk has really helped you kind of assuage some of these concerns. While machine learning is incredibly valuable towards identifying opportunities, analyzing relationships, determining factors, setting the rules for decision making, and learning from previous actions, there are no standard approaches. It's the Wild West right now. And there are high degrees of freedom even when those standard approaches do come to light. Therefore, there is a low chance of commoditized returns due to increased interest in AI activity. As such, this tragedy of the commons issue does not apply. So, what's my ask? As I mentioned, coming out of this meeting here, where we're all huddled around the computer, this was one of the great machine learning companies. It was based out of Seattle, and it was later acquired by Amazon. But the problem that we had was that I actually went to Seattle and kind of stalked them to have this meeting, and I said, listen, I want to apply some of these things, but the problem is different. We have all these problems about, short history of our explanatory variables. We have problems with sequential learning. We have problems with catastrophic forgetting. Like, can't we work together to solve some of these answers? And their answer to me was, thanks for the flight. You're right. But you're one of the few that realizes this. And your wallet's not big enough for us to drive these types of decisions. As such, I decided that versus at JP Morgan, where I could just call people in and tell them, here's our checkbook, do what I want, I'm out here. And I'm trying to convince all of you to pay a lot of attention to this industry, to drive innovations, to have demands, right? To require that this is not just something that is nice for TV, but that it actually is applied within capital markets where you can actually very quickly track on a day in and day out basis whether it's adding value. As you can see and hopefully can tell, we're 100% all in on artificial intelligence and the promises of big data. We work on this every single day of every single moment, and I'm happy that our CTO has taken a moment out from our pressing issues to sit here and listen to this. But we really want to work with others, right? Particularly there are new frameworks required for knowledge sharing. Right? We're here because we were able to benefit from the declining cost of compute power, but we're happy to help others who don't have that situation and to help think through those. And most importantly, I hope that as you go through the rest of these presentations, that you not only think about kind of what are the promises, but what are the realities of these things. And to the extent that you ever do really dive in, get your sleeves rolled up, or that you have questions that you could use some help answering. You know, our core focus is around turning our investors' money into more money. However, in that pursuit of alpha via artificial intelligence, we create new intellectual property every single day. And it's our goal, particularly with suppliers, to enable them to open source that or license that to a variety of others. These are the early stages of what we call the next industrial revolution or the data economy revolution. And therefore, what's most important is that we continue to work together, we continue to grow this category, we continue to drive investment to those who are really thinking about this in a sophisticated manner. And then, in 5 to 10 years or 10 to 20 years, we can start to have sharp elbows and try to push each other off the stage. So with that, thank you very much for your time and for dealing with my technical issues. Who's the tech guy that can't get his computer to work, right? You know?
So nobody who starts out with the same raw data is going to get the same answer. Is everyone just betting that they're the one person who's going to be smart enough to find the answer? Or are there a million ways to win and all you have to do is find a path?
There are multiple ways to win. That would be the short answer to this. I think that what you'll see is that within any given problem set, there is a capacity of how many people can get the right answer. However, that capacity is extended because we all have different durations and we all have different risk profiles associated with it. So even if you get the data side correct and you get the analysis side correct, then you're going to have diversity associated with the inputs that go into our decision-making function, which will still enable the alpha to remain. So we try to get comfortable with being able to present in large groups about the types of advanced things that we're talking about, but we have to draw a limit somewhere. So that's really what it is. You can't go to a single conference without people talking about news data, so I decided to mention that, and in reality, I should have deleted the flight data from that presentation. Indeed.
I noticed it said extremely confidential, do not distribute.
Yeah. Indeed, you know.
Appreciate your candor.
Yeah, we try. It's very hard, as I mentioned, to put all this stuff together. However, I do have investors and a board of directors that I have to worry about to some extent.
Did you find that a lot of the machine learning algorithms that are open source worked well out of the box for the economic data you're looking at, or did you have to do a lot of customization?
Depends what you're trying to do. If it's really just about clustering, then it's fine because you don't have to worry. Sorry, to be simple. If you don't have to worry about the bitemporal data problem, which is the fact that the same piece of information or circumstances that occurred in 2010 does not apply now, then a lot of the stuff that they do is okay. But if you have to think in terms of sequential learning and the fact that kind of Apple will react one way to a price announcement today, but last week it'll react very differently to the exact same piece of information, then that is very challenging, and that's really the core of what I want more on the West Coast to be paying attention to. It's not part of the problem that they care about, because if you just think about yourself, right, you're kind of a 20 to 30-year-old, 5-year-old guy. You tend to like these types of things, and regardless of whether you go to Amazon and then you go to Google or then you go to Facebook or Netflix, all that information's all the same. So they just decided to drop it. Right? Because you're not really changing that much over time. And there's a problem with sequential learning in artificial intelligence, which is that AI, as it continues to learn, it writes over its previous learnings. Thank you very much.